Hey traders, this is Blake Morrow with Trader Summit, and I have with me, and it's been such a long time, I've got Alex Barrow from Macro Ops. Good to see you, Alex. How are you?
Hey, good to see you, Blake. Always good to be on, man.
Yeah, it's good to have you on, and I know we're just passing the holidays. Really, really kind of very volatile 2022. How have you been navigating, as we're wrapping up 2022, how have you been navigating through this year?
Yeah, so it's been it's been a grind. No way it doesn't matter which way you cut it, but luckily we came into the year November, December 2021. We turned decidedly bearish just because the Fed clearly changed their messaging. Inflation was looking like it was going to be stickier than the narrative had originally priced in, and so we went to mostly cash and net bearish positioning around December, January, and so that we did pretty good, and then we were luckily one of the few shops to call the Russian invasion of Ukraine back at the start of this year, and so we got long wheat, long some other commodities, and we were doing really good going into the spring, and then unfortunately we just ended up kind of getting burned in the chop and grind through the rest of the year. Staying too active in equities, more so than we should have, because it didn't really match up with our broader positioning, which was stay bearish, stay high cash levels most of the year. And so there's a lot to learn in that. We're doing an end of year review, which we're gonna put out next year. But it's something we can always learn. It's like sitting at a poker table, right? It's like if you're a pro poker player, you play the hands where the odds are always in your favor, and you don't need to play every hand, right? You sit and you wait for the cards to come to you.
Yeah.
And as traders and investors, we can learn a lot from that. And it's hard when it's it's your full-time job, and you come down and see your desk, you want to put on trades, and you could get overeager. So luckily, I mean, we're at about 10-11% on the year, which is better than the broader market, but not nearly as good as where we could have been if we would have just went to all cash back in May and taking the rest of the year off.
Sit on your hands. It's interesting. It's always a new year, and we're coming up on a new year, obviously. And what are your thoughts going into 2023? Because I was reading your most recent Dirty Dozen chart pack that you do post on the Trader Summit, and it seems like you're tilted kind of bearish here. You're bullish commodities. What are your thoughts as we head into next year?
Yeah, so it's a tough picture looking out for the next 6-12 months. We are bearish longer term. All of our recession indicators are triggering high probability of a recession within the next 12-18 months. But on the other hand, that's also a very consensus call, and it has been for the last 6 months. The only sense in that and how we differ is that the narrative has been calling for a recession at the very start of the year. For the last 12 months, we've been saying that's a second half 2023 story, mainly just because household balance sheets are still really good. We think, especially with the China reopening, that's going to add a little kind of bid under global growth, and that's going to help a little rebound going over the next 1 to 2 quarters. And we'll have to see how that plays out. Obviously, we're looking at the latest high frequency data just this morning in China, and COVID spreading a ton. Subway rides are down a bunch week over week, but that's probably going to burn itself out over the next 3 to 4 weeks, just in time for the Lunar New Year. And so we'll have to see how that plays out. But I think that's going to be good for global growth overall. And I think, this fall in inflation that we're seeing, maybe the Fed kind of easing up on their hawkish rhetoric after another couple months. I think we see maybe markets rebound for the next couple months at the start of the year. But again, I think recession is high odds in the second half of this year. It's way too early to tell if it will be a severe one or not. So we're expecting basically a lot of chop and ball in U.S. large caps, especially. We think there's a lot more downside for the mega cap, the Apples, the Googles, the Teslas, just because there's so much space for those to re-rate. I mean, capital concentration is still at record levels in just a few names in the S&P 500, and so it's going to be a trader's market essentially, and it's going to stay nimble, strong opinions, weakly held type thing. So
that makes a lot of sense to me. Let me ask you about how you're feeling with, you obviously said and your call about the Russia-Ukraine situation, and this wasn't something that we talked about pre-call, but do you have any thoughts going into this next year regarding Taiwan and China?
Yeah, I think the way we think about it is just all in distribution, of outcomes, and then try to weight them, probabilistically. But with the Russia call, it was pretty clear. I still have a lot of connections to the former Intel world and stuff where I used to work, and so anybody who was following anything other than what you were getting fed in the news, you knew that it was a high probability. And then a week before, we got word that it was almost certainly going to happen within the next 2 weeks. But with China and Taiwan, I think that's a black. Whenever you're talking about what the CCP is going to do, it's a black box. I don't care who you are, how much Chinese history or how closely you follow the CCP, but it's a total black box. We think that broadly speaking, and I kind of talked about this in the latest 30 Dozen, we're a new general macro regime over the next decade, 10, 20, maybe 30 years plus. And this is because we're seeing a syncing up of a number of cycles: long-term debt cycle, cooperation versus competitive, geopolitical cycle, inequality cycle, and all these things just trend towards. Historically speaking, a good analog would be pre-World War I, where you saw again a peak in globalization, trade openness, global financial integration, and all that stuff, and then a reversal that happened, over 30 years. And we saw that peak in about 2008, synced up with the global financial crisis, and there's reasons for that. And there's reasons why the term is a polycrisis that a lot of people have been using. Is you're seeing just growing friction within the geopolitical global system on all fronts, and it's happening faster than really narratives can keep up with. And so I think Taiwan's going to be a growing hot point, a friction point between the U.S. and China, because we're becoming more competitive, and that's gonna, it's like that's like a trend, right? But we'll see cycles around that trend. I think there is some reason for optimism. Both China and the Biden administration are teaming up to try to push Russia and Ukraine to the negotiating table for a ceasefire and hopefully an end to the conflict. That's still a big if, because it's going to take a lot to bring those two sides together. But they are, from the people that we talk to, they're applying a lot of pressure on that front, both fronts. And the fact that China's so involved in it too means that maybe Xi is working to try to cool a little bit of the tensions, because after the protests that he saw in his own country this year, and they're in a really bad recession. Their growth situation is really bad, and because of their demographic and debt picture, it's not going to get much better. So he's probably trying to find ways to boost some growth and cool things off. And so maybe I don't think we see China invade Taiwan this year. I think that's a very low probability thing. I think over the next 5 years, it's an increasingly high probability thing.
Okay, well, I appreciate your on the off the cuff thoughts on China. I know you had a couple charts that you wanted to discuss with our listeners about what you're seeing going into next year.
Sure. Yeah, let me share my screen. I'll pull it up.
And by the way, while Alex is doing that, if you like this content that you can't get anywhere else, make sure you subscribe to the channel. Give Alex a big thumbs up for spending his time with you pre-New Year's. So thank you, Alex, for doing that.
Yeah, my pleasure.
All right.
Always, dude. All right, so I could just, I'm just throwing together some charts. This thing's unfinished, but I'll show you guys some charts that we're looking at to kind of just put together a 2023 roadmap. So this is our growth composite indicator. It's a composite of 11 different hard econ data, soft econ data points, liquidity indicators, and that stuff for both primarily the U.S. but also some global growth. And so it's a Z-score average over a 2-year period, and what we're kind of tracking is just when it turns negative. You can see the red dot here, going back to 2000, marked predated the recession, and then when it turns positive, it has a pretty good lead time on bottoms typically, or sometimes a lag. But this is just big picture stuff. So we can see that it turned negative in the spring of this year. It's pretty deeply negative. This is just in line with kind of our prediction for a recession in the third or fourth quarter of 2023. Here's our regime indicator. This is kind of just a different quantitative way of looking at the previous one. We recently dipped into a contraction. We've been in a slowdown territory since pretty much the start of 2022, and we expect to be in contraction for most of 2023. And historically, the 6, 12, 18-month forward returns when you're in a contraction for the S&P are very poor. It's the worst regime to be in for equities.
Got it.
Our liquidity indicator, which is just a composite of a number of rate of change, looks at 10-year yields, high yield spreads, and some other things. Liquidity, leads markets. It leads the hard econ data. It turned deeply negative at the end of last year. That's no surprise with what the Fed's shift in policy and the moves that we've seen. It's still very deeply negative. We expect it to probably stay negative for a while, but this is something we'll have to watch. Again, not a good macro indicator look for U.S. equities. All right, here's our leading inflation indicator. This is a cyclical indicator. It has a lead on inflation, core CPI by about 12 months. So it's coming down right now. It's projecting that CPI, core CPI, is going to end the year at roughly, it's probably going to end the year roughly like 3.5% range, which is essentially kind of what the market is pricing. But we think it's going to take potentially take a little bit longer for it to get there, depending on how this China reopening goes. And just and on that point, kind of one of the areas that we're looking at is that we think the market is a little too aggressive in cutting lower interest rates, because at the start of this year, we think, especially with the China reopening, that yields might stay higher for longer, and so that just means tighter policy, tighter liquidity. Again, which isn't great for risk assets. Here's some of our main recession indicators. You can look at the Philly Fed coincident index. It's fallen to a level that over the last 60 years has led to a recession every single time. Our Probit model says 100% odds of a recession within the next 12 months. All parts of the curve are inverted. Conference Board LEI again. So it's just it's just
not confirming that it's next year is going to be a tough year.
Yeah, that's it. And it doesn't mean we're going to go straight down. Again, like I said, these indicators can work with long lags of 12 to 18 months. It just means that, probabilistically speaking, unless something dramatically changes, for whatever reason, we bring in a bunch of fiscal stimulus, but I think we're pretty constrained on that front just because of where inflation's at. It's equities don't do well when you're about to head in recession ever, for good reason. But on the bright side, with the China reopening, and if you look at the China credit impulse, we should see that tick up a little bit more. That's been deeply negative over last year. That has a good 12-month lead on commodities in general. Here's the CRB raw industrial metals index. So we should see metals, things like copper and stuff, probably do very well over the next quarter. Again, especially if you think recession gets pushed off until the third, fourth quarter of this year, there's some room for some good tactical long trades in commodities, oil too. So that's an area that we're watching.
Got it.
Just long term, thinking we're of the mind that we're in a new commodity super cycle. We're about year, 18 months into this one, and so we think we have a long ways to go. If you just look at general broad capex trends for the commodity space in general, there's a lot of reasons to be bullish on the space. One of our favorite markets, looking out over the next 2 to 3 years, is precious metals. This is a yearly chart of gold. We have a nice rounding bottom, and there's a lot of similarities, to the analog of the late 90s, early 2000s, and today. And similar capital concentration in the U.S., which is a big driver of forward U.S. dollar returns. Projected forward equity real returns for the S&P over the next 10 years are about zero or to roughly negative, especially if we're looking at large caps, which is where most of this capital concentrates. And so when you see that, and the reason why gold did so well post 2000 was because you see a big reversal of those capital flows back from the core back to the periphery, and that is really good because precious metals, gold in particular, tends to be kind of an anti-US dollar asset bid. Yeah. So we expect gold, miners, silver to do very well over the next couple of years. Again, here's just kind of a chart with the forecasted 10-year forward returns for the S&P, and you can see how those sync up with the returns on gold historically.
Interesting.
And then, you know, net spec positioning for gold, it just came off, you know, very historically bearish levels. And we can see, you know, that kind of happened in 2018, which preceded the last, you know, multi-year bull run, and again happened in 2015. And we saw, you know, we got really bearish here in 2006, you know, and so there's a lot of tailwinds for precious metals. As looking out at a lot of things like over the next year to 18 months, it's hard to have conviction on any long-term trends because the market, I think equities are going to be very volatile. I think energy is going to be very volatile, but precious metals, which historically halfway through a bear market in equities, tend to bottom out before you see a turn in the broader market. And because they start sniffing out a turn in the Fed policy before all the other markets do, and they tend to do that, and that's really when they start to run. And so, you know, yeah, maybe some more consolidation over the next 2-3 months, but I think once they starts to, you know, sense out a little bit more slowing growth globally, and the impulse from the China reopening kind of wears off, I think precious metals are going to start to run maybe near the second half of this year.
Interesting, yeah.
And then, you know, a kind of a corollary to that, just because they're so closely linked as the dollar. Here's, you know, we like to look at yearly charts at the end of the year, just kind of see broader trends. And it's going to be interesting to see where the dollar closes this week out. But, you know, had this big breakout, which it's nearly, you know, looks like it might, if the dollar sells off this week, we could end up with a big kind of bull trap in the dollar above this key level. You know, that's held over a long time. And so that would be interesting. And especially if you're looking at kind of general yield spread trends, here's the dollar trade weighted dollar yield spread on an aggregate basis. We can see that it's turned lower. You know, the dollar follows the spread in yields over a longer time frame, and we can see that in kind of the oscillator of that, which just tracks the momentum. You know, we've seen big moves out of the ECB and the BOJ recently. So there's, you know, a chance that other countries start catching up a little bit, and just at the margins, that can mean a lot for a dollar which got very overextended last year, especially at the start of the year. So
yeah, it's amazing how you know, how many people were targeting much lower prices in the euro when it was trading below parity, and now, you know, they're kind of looking at a different picture the last couple of months.
Right. Yeah, and that's always the case, isn't it?
Yeah.
Everybody's chasing price. So yeah, and that's I mean, big picture, these are, you know, the big markets we're watching. It's going to be definitely a trader's market. There should be some good trends, but yeah, I think baseline case is a lot of chop and volatility, a lot of dispersion between different markets.
All right. Well, Alex, I'll tell you, I know here at the Traders Summit, we appreciate your work almost on a daily basis when we get it. And I appreciate you being here with the traders in our community. Can you tell us how we could better closely follow your work at what you do?
Sure. Yeah, you could you know, check out our work at macroops.com, which is macro-ops.com. You can find me on Twitter at Alexander Barrow at macroops. And that's it. Yeah, shoot me, you know, follow me on Twitter, shoot me a DM. You know, sign up for our free stuff. We release a couple free pieces a week, and yeah. That's about it. Yeah.
And we love it. And being that you are you know, Marine, and I'm also a Marine, you know, I love supporting fellow, you know, jarheads. So there we go.
Yeah, thanks, Blake. I appreciate it, brother.
All right. Well, hey, Alex, thanks for spending your time with us. I'm going to catch up with you in the beginning, first quarter of next year, so we can get caught up and see where you're at going into 2023 as we plow through it.
Sounds good, man. Looking forward to it.
Happy New Year to you and your family, and to everybody at the Macro Ops team.
Right back at you, dude.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.